Hello, everyone, and welcome to another podcast from Edani Management. We're here with Mark Abramovich, the lender, and myself, Craig. We're going to discuss today securing your financial freedom and retirement using multifamily properties. This is a topic that's very near and dear to our hearts. We get approached by investors, um, high income individuals, and also individuals, middle class, all kinds of classes of people who see real estate as a vehicle to secure their financial freedom. They want, income in retirement. They want to make sure that they're secure. And for a long time, real estate has always provided that for a lot of individuals. And today we're here to talk about that topic. We're not financial planners or registered investment advisors. So, this is just entertainment, and always consult with your tax professional and your licensed investment professional before you make any decisions. So welcome, Mark. How are you doing?
Doing good, Craig. Yourself?
Pretty good. Pretty good.
Excellent.
So yeah, let's jump right in here.
Sure.
I guess kind of tell me your take on this whole thing of using real estate as especially multifamily property as a way to augment and secure your financial freedom and retirement.
Okay. Well, so let's start from the top, and we'll get to why multifamilies a little bit later. Everybody's aware there's multifamily, single family. We'll get to that a little bit later in this podcast. But let's first talk about financial security and active income versus passive. Let's just start there. So active income, right, is income we all earn from jobs. You work, you have income. You stop working, there's no income. That's kind of the bottom line to it, right? You work, right? So we work, we earn, we spend. The cycle continues, and you're earning, you're spending, you're earning, you're spending, you're earning, you're spending. Okay. Passive income is income coming from investments where you don't necessarily have to do anything. And now the money every month or every quarter or however often is coming in from investments you've made previously, dividends on stocks, interest on a loan, things like that. So active income is income you get from working, typically a job, right? The more you work, the more you earn. You stop working, you stop earning. The idea is to convert that active income into investments that then provide passive income. So after working the job, right, people ask me, well, Mark, how did you buy your first property? Where did you get the money? I worked. It's a pretty simple answer. I worked, I saved, and then I used that money as the down payment on the property. Now, once the property started cash flowing and I started having income coming in from the property, I started saving up that income together with my salary from my job, so that the next building actually happened a little bit faster, because now I had my regular income that was still right. I could save up as I did previously, but now I also had income from the property. Okay. So
let's contrast this with, I guess, the way you're typically taught to save for your retirement. You work a job for 40, 50 years, 60 years, and just kind of save what's left over in a tax deferred vehicle, 401k, IRA, and try to save enough, try to get the market to give you enough return so that you have enough in retirement to live off of. So basically you're kind of just hoping that the market will treat you the right way, hoping that you'll be able to save whatever's left over in your life after your daily expenses to accumulate enough to retire. And as we all know, things are getting more expensive. The cost of living isn't going down. So
you're actually hoping that your money outlives you.
Yeah.
That's the real hope. You're hoping that your money outlives you instead of outliving your money. You're hoping you die before your investment, your savings do.
Right, which is a big worry to a lot of people, because they know that this is just not enough with the way things are going up in price. They want to live an easier lifestyle than they did when they were working. They want to be able to travel and all those things. And sometimes it's just not enough, and real estate really offers that way to multiply that income. If you can acquire these properties that are like mini investments, mini income generators that
Yep.
help you to do more.
Sure.
um, so how does this fit in with a typical 401k or with a typical IRA? How can we use this to like diversify and add on to a typical retirement strategy?
Absolutely. So retirement vehicles and other investments, right? So you mentioned it. What do most of us, and I'm included in this, right? I had a job. I saved in a 401k. I had a 401k match in a 401k account. Typically, especially if you're working at a job, that 401k can only be invested into certain things that you don't necessarily control, right? So you've got your choice of mutual funds. On top of it, you've got fees and everything else. So, and you're getting what you're getting, right? You have no control over the market. Somebody likes a brand, it goes up. Somebody doesn't like a brand, it goes down. It almost feels like we've lost the connection of what stock value is really supposed to be in mutual funds, right? And a mutual fund is essentially a collection of stocks into one big pot, where again, it's diversifying risk, right? So if one particular stock goes down, another one goes up, the fund overall kind of maintains its value. Okay. Now, there are self-directed accounts. So for example, when I left my job, I was able to take my 401k and roll it over. And I actually rolled it over into a self-directed retirement account. Now, I have the ability to use those funds to do whatever I want with. I mean, it has to be within, it has to be legal. There's constraints, tax wise, but I can invest into more things, including making loans, including buying real estate. So I have, there's that ability. Now, that's a retirement account. So that's just money set aside into a specific retirement account. But let's go back to actually having diversified investments. So you can have a retirement account such as an IRA, 401k, and additionally to them, you can have rental properties also feeding you income.
Okay. And what's some of the benefits of adding rental properties to your retirement portfolio? I guess how would someone start even identifying,
Okay.
where to invest? Let's start with the markets.
Sure.
How do you identify a
Sure.
good market to invest in properties?
Okay. Let's have a real fast recap of why real estate, and then we'll get to markets.
Okay.
So fast recap of why real estate. We have our cash flow, we have our mortgage pay down, we have our appreciation, depreciation, and inflation hedge, right? So those 5 things working for us with investment real estate. Okay. Markets. So identifying a market, it has to be a market with multiple industries. There's you want multiple industries. What you don't want is one factory town. The factory shuts down, the town is gone, the rental properties are worthless. So what you want is bigger, areas where multiple industries come together. Um, you know, an example is Jacksonville, Florida. It's a port town, right? There's a huge port. You have a lot of sports teams. You have a lot of tourists. So there's multiple things happening in Jacksonville that make it a stable rental market, as an example. So rentals in general are a good idea. Okay. I mean, Craig and I are obviously big believers. We own our own rentals. We keep buying more. And in general, real estate definitely falls into the category of necessities, not wants, right? In life, everybody has certain survival necessities, right? We all need food. We all need shelter. We all need clothing. You can't get around without it. So shelter definitely falls into it. So that's where real estate comes in. Everybody needs to live somewhere. And so it is a necessity. And, you know, I mean,
Right.
that's
So
kind
we
of the,
can look at some other things in the market too. Like I know a lot of investors, we look at taxes. Some states have much lower income taxes. Some states are much more friendly to
Mhm,
landlords. Typically, the southern states tend to be more friendly to landlords. Florida,
mhm.
Ohio, Texas,
Yep.
Alabama. Eviction laws are easier.
Yep.
Uh, Sometimes purchase price is even better than some of the more expensive tenant-friendly states on the coasts, like New York and Florida. So that could play it into selecting the market as well, and
Yep.
also where you have relationships with either property managers or other investors. And you have some boots on the ground, because that's really important too, to select somewhere where you have some boots on the ground, and that can
Well,
help you to get the best best
I
best
don't,
outcome.
I think the word is not important. I think the word is vital.
Yeah.
you know, um, selecting the market is important. Who's going to manage the property, I think, is even more important, because you can have a great property with an atrocious manager, and they're going to run it right into the ground. And you can have an okay property that's going to perform fantastically with a good manager. I think management is even more important in all of this. But
Yeah.
uh,
So while we're on management, tell me,
sure.
like, what are some of the things we should look into when selecting a property manager? What do you look for when interviewing property managers?
um, one of the first questions actually is size. How many units do they have under management? You want that number in the 3 to 500 range at minimum. Realistically, it means they've got enough systems and processes already to know what they're doing, and to have the back end figured out. Um, you know, uh, that really is actually the first question to ask. I think, if they have too many units, you kind of become. I feel that you become a number, in the ledger book, rather than an individual client. Um, so I think 3 to 500 doors under management is kind of it's the minimum, and at the same time, they're small enough where they'll know you, big enough to know what they're doing. I think that's one. From a management perspective, I think you and I discussed it before. We can talk about it again. The fee structure. I don't want to be nickel and dimed on fees. I'm okay with paying a higher, let's say, just flat percentage of the rents coming in, but I don't want to be nickel and dimed where, okay, it's going to be a little bit for this and it's a little bit for that, and we're going to charge a fee for this and we're going to charge a fee for that. It's like, just just tell me how much you're charging realistically. And what's funny is, uh, practically speaking, it kind of comes out to be about 13 to 14% of the income coming in is what goes out as management. Now, what's funny is the breakdown of this, because some people, even in our case, we charge 10% for management, right? At Idani, we typically charge 10% management from the gross incomes. But here's the funniest part about it. We also charge a lease up fee. And pretty much all property managers charge a lease up fee. Why? Because a lot of work goes into placing a tenant. You're screening the tenant, you're showing the apartment or house or whatever else, you're showing it. So there is a significant amount of work that goes into it. So typically, property managers will charge a month of rent, right? The first month. Now, if you consider that month, if you take an average lease length, right? Average length of stay at 3 years, right? So you take that 1 month and you divide it by 36 months, that roughly comes out to be 2.6%. So actually, if you take 10% of as a management fee plus the 2.6%, it roughly comes out to be 13% is the management fee. That's just what it works out to be.
Yeah.
So I don't want to be nickel and dimed. I would rather just know that flat number I'm going to be paying. Great. Every month, the manager collects their fee. I get my rent. End of story. Now, obviously, there's expenses that come out. Now, in terms of markets, there's an interesting kind of something, this nugget to look at. You don't want to be investing in a super cheap market, a market with low rents. Why? Well, in a market where rents are running $500-$600 a month, the cost of a vanity at a Home Depot is typically the same as in a higher end market like New York, Dallas, right? I'm not talking about right now where you should buy rentals. I'm just talking about the cost economics, right? A vanity in a Home Depot in New York costs roughly the same as it does in Birmingham, as it does in Los Angeles, as it does in Jacksonville, right? Both North Carolina and Florida. So, but the problem that comes up is if you're renting in an area where it's $500, what can end up happening is you burn through much more of that saved up capital than you would in a different market, right? You know, a single repair can burn through all of the profit just because of cost of material, cost of supplies. Okay. So that's kind of like this unique little, economic moment that I didn't necessarily realize with some of the rentals I own. Luckily, rents have crept up over the last couple of years to make it more manageable. But I own properties in North Carolina. My rents now are finally at around $850 for a semi-attached, half a duplex. But I didn't realize this initially when I was buying them, because the cost of, like I said, the cost to recarpet if there's an issue, the cost of a fridge, right? A fridge costs pretty much the same regardless of where you are. And I'm not talking about jumping between, a regular 18, the standard white,
18 cubic feet
foot fridge we all know,
yeah,
right? Versus stainless steel LG touchscreen. That's not what I'm talking about. I'm just saying that same exact 18 cubic foot fridge is the same $600 in North Carolina as it is in LA.
Yeah.
Right. Except in LA, I would be renting out an apartment for a few $1,000s a month versus $800 a month.
But did you find your labor costs were cheaper in those low rent markets, or not enough to compensate?
They're not enough, because labor is great, but when we're talking about replacing windows, when we're talking about replacing a fridge, when we're talking about, the material cost is so high that labor cost, the fact that, so labor cost in North Carolina might be $10 to $15 an hour instead of $25 to $30 an hour. It's not such a huge offset. And I mean, obviously, I'm not talking about building. I'm not talking about large scale work. I'm just talking about, touch-ups here and there, turning over an apartment, right? Let's talk about turnover. If I needed to paint, the labor to paint is going to be cheaper.
Yeah.
Okay, so what are we talking about? 8 hours of labor? Okay, fine. Let's just do some rough economics. Or let's round it up to 10 hours. 10 hours to paint, right? First coat, second coat, whatever, spackle the holes in the beginning. Let's say 10 hours at $15 an hour, that's $150. Let's say it's the same, the same at $30 an hour. Okay, that's $300 to paint. But the big difference is the paint. The paint itself, and this will show everybody, which one of the two of us handles, operations in our business.
How much is a 5-gallon can of paint, Mark? Come on.
Right. So how much is a gallon of paint? Let's say it's $20, $30, right? Depending on the paint you're using. So if it's $30 and you have to use 5 gallons, it's $150, regardless of where you are. That $150 is the same.
Yeah.
So we're talking about $150 in paint plus $150 in labor in North Carolina. So that's $300 versus $450. It's a difference, but it's not such a huge difference. Right. But relative to an $850 rent, it's pretty big.
Yeah. So where would you say is a sweet spot for these rental amounts? I know sometimes these low rent and low property price investments can look good on paper,
Right.
but when you factor in all the maintenance and the cost and because the rent is not that high compared to your fixed cost, because you do have that fixed cost that you just have to go
Correct.
over to make a profit. What would you say is a good number for rents that would kind of hit that
As high as
sweet spot?
possible, correct? As high as
Oh,
possible. There's no sweet
no.
spot, right? The more rent you can, the more rent you can charge, the better it is. But what's interesting is if you plug this into your analysis, right, into a spreadsheet and figure out the numbers, well, that tells you the market you should be investing in. That actually goes to telling you what market you should be investing in, right? The income versus the fixed costs. Obviously, counting everything else, right? Whether you want to be there because it's got the industry, whether you want to be there because the landlord laws are better, right? It's the difference between New Britain, Connecticut versus Bridgeport, Connecticut versus Stamford, Connecticut, right? All the same state, similar law. I mean, the laws change a little bit by, let's say, county or city, but similar.
Typically similar operating environment
Correct.
there. And yeah,
Correct.
I mean, we run the numbers on these properties, and some markets work, some don't. So
Correct.
we
Correct.
really, I guess the lesson here is you really have to do your analysis and do your run your numbers in your spreadsheet, do the math, and the math will
Yeah.
tell you what to do.
Correct.
So
Well,
yeah.
with that said, let's get to the nitty gritty of what we were talking about, discussing today, which is multifamily, right? The pros, cons, benefits of multifamily. I mean, you
Yeah. So for us, I mean, in my personal experience, I mean, when I started, just green, not knowing exactly what I was getting myself into. Uh, and I did start with multifamilies, but you're gonna have vacancy. You're gonna have
mhm.
tenants who are late, can't pay for this and this reason. And I mean, to be honest, the saving grace was that I had other units in that building that were paying while one or two decided not to pay. So I think the biggest benefit of multifamily is you have that diversification of income and spread
Mhm.
out. So it's not just one unit. If you have a single family and they stop paying, that's 100% of your income loss. Whereas if you have four tenants in a fourplex, one stopped paying, you still have the other three to cover while you work out your kinks. So I mean, for me, that's one of the biggest benefits of multifamily as opposed to single family. On the management side, things are a little harder because you have to deal with issues between tenants. You may have conflicts with from one to another. Obviously, you now have four fridges to replace. If
Mhm.
four water heaters, four boilers. So you have a little bit more equipment to maintain. Hopefully, they all don't break at the same time. But we have strategies to manage that here at Idani, and then we found that just from analyzing thousands and of properties that the multifamilies just perform better, especially in Connecticut where there are abundance of them, and a lot of these. I guess before they were single families that now have been converted to multifamilies. Before you had a lot of families kind of living in one property, and it would be separated out, but not by utilities. Everything would still be connected together. Now they're all chopped up into actual separate dwelling
Mhm.
places. So, you can have separate families in one property. So, multiple streams of income. That's the name of the game. And multifamily, I think definitely it really achieves that goal.
Well, so let's talk about multifamily. So let's talk about the benefit, the pros, cons, kind of, let's dive a little deeper into it. So, you asked me before we got on the call, what are the differences between multifamilies, right? Kind of an overview of them. In the financial sphere, there's the 1 to 4 family multifamilies, and well, 1 to 4, 2 to 4 essentially, and 5 and up. And the big difference is the way, from a financial perspective, the way they're looked at for financing, where 1 to 4 family houses are treated based on sales comps. That's how the valuation is determined. How did the neighbor's house sell relative to yours? And then that's the valuation basis. Whereas 5 and up, they're treated based on their income, right? So what is the rental income? What are the expenses? That gives the net operating income. And there's some valuation that in this market, this is worth this much money. And this is how the value is determined. And depending on whether it's a 1 to 4 or 5 and up, there are different financing options. Typically 5 and up, cost more. The appraisal now is no longer just a sales comp, but now it has to be calculated. There's valuations, the appraisal cost, just to give you guys a difference. So personally, I own a 3-family in Bridgeport and I own a 6-family. Okay. And the difference was when we were refinancing the 3-family, because it's less than 5, right? The appraisal for it was $800. When we were refinancing the 6 unit, the appraisal for it was $2,400, plus we had to do a survey. It was required by that lender in Bridgeport. So just to give you a comparison of overhead, right? So we're talking about an $850 appraisal versus almost $5,000 in fees, right? Between appraisal and survey. That's the difference. But on the other hand, my 3-unit was being treated based on what it was appraised at. They looked at the rents, great, got the loan. In the case of the 6-unit, the way it was valued was not the sales, but actually what is its cash flow? What is its rent? What is its income coming in, from rents? What are the expenses? And that was how the valuation was determined. And especially what's important with multifamilies this way, and when you get to bigger units as well, is you can force appreciation, right? Because you buy a property that's underperforming. The previous landlord hadn't raised rents in, 20 years. They've got people living at 20 years ago rents. Well, guess what? I'm not paying what it's going to be worth. I'm paying what it's worth today. So based on those, let's say the rents are $1,000, there's 10 units, so the income is $10,000. Okay, it's worth whatever it is, right? $1 million. But then if you come into that property and over the course of the next year to 2, you stabilize it, you increase rents, you essentially, you turn over whatever needs to be turned over, right? You repair, put in some maintenance, and you get the rents up to $2,000 instead of $1,000. You've just doubled the value of that property. That is the power of the 5+ properties. Up to a 4-unit, okay, you spend the same year, raising the rents, getting it to market rent, great. In the end run, if 4 families down the street are selling for $400,000, guess what? Your 4 families worth $400,000. You can't force it to be worth $800,000 because that's not how it's appraised. It's not how it's valued. But on the other hand, when you've got that 5+, when you have that income and you take that income from $1,000 to $3,000 per month for all of the units, you triple the income. Guess what? The value now triples, or whatever the math works out to be. That is the.
Do you have some insight, Mark, into what that math is? I know the cap rate plays a role there, but
Right.
How do they actually value this using the income? Do they, do you know the exact calculation?
Cap rate? I really don't want to open the spreadsheet right now. In the spreadsheet, there's a formula that takes, I think it's NOI multiplied by cap rate. Sorry that I don't.
That'll give you
Shame
the
on
value.
me for not knowing this offhand, but.
Right. Well, just some of the lenders I know you work with, maybe they might, I don't know how close you are to some of the underwriters, but I know sometimes they can leak some of their secret valuation calculators for Connecticut, or I guess it's more on the appraisal side.
But it's not a leak. I mean, it's pretty much NOI times cap rate. That's what drives that value. And it depends on what exact, when the appraiser is doing his appraisal, it depends on what exact cap rate they can put on a property. Now, here's a little tidbit for everybody. You can dispute an appraisal. Okay.
But then do you have to pay again for another one?
No, you can dispute an appraisal report at least once for free. Okay. Now you need to have your comps and you have to have your data to back up your argument. And again, Craig, the 6 unit, when we were refinancing it, the initial appraised value came in, like it was ridiculously low. I don't know what the appraiser was thinking. I don't know what he was doing. And it was a he. So I turned around and I challenged that. I mean, listen, we're managing in the area. We knew what some of our clients had paid for properties. We knew what the incomes were coming in. So I disputed the appraisal to get the value higher. So I'm just telling everybody, and it doesn't matter if it's multifamily, single family, when you get an appraisal report, you are allowed to dispute it. You don't have to just take it. Okay. Yeah. Obviously, just keep in mind, nobody likes to be told that they did a crappy job. So have a little kind of take the appraiser's, professionalism also into, consideration. But if you have the backup, right? If you've got the values, if you know the market, and you have, data to back yourself up, dispute the appraisal, which is what we did. So we got the value higher. So that's just a quick overview of how,
the difference between the 4 unit, 4 and under, and 5 and up for multifamily. Yeah, that's great to know. How about some of the tax benefits in the future? I know, we have this beautiful thing called depreciation that we can take up to, 27 and a half years the IRS gives us to claim depreciation on a property that's actually appreciating in value. But we do get to claim that. And that can be a benefit in retirement, because if you have other income that's coming in, into that passive bucket, whether it's dividends or whether it's, other income from your 401k, you can potentially offset that with some of that tax shelter called depreciation over the life of the property. Now, depending on when you purchase it, it runs out, but because you can only claim it for 27 and a half years.
Just really quickly, let's put into simple terms, right? Depreciation sounds high and mighty. Very simply put, it's the wear and tear on a property. That's essentially what it is. The IRS says, hey, every year the property is in use, it's being worn away, right? It's
wearing out. It's wearing out.
Right. So you can, a graceful way of saying it.
You can take a paper loss
correct
for that percentage of the value of the property that's wearing out.
So that's what depreciation is. And so they're assuming that you're saving or spending some amount of money on the wear and tear, and the value is losing. So that's what depreciation is. So yeah, sorry, Craig. So
that puts us in that income gets taxed at a lower rate, because even though this is not a cash expense, it's just a paper. When we're filing our taxes, we write that off. So our net income gets taxable income becomes lower, and we pay less taxes on that rental income. So that's another benefit in retirement that we can get from this passive income, that it's taxed lower than income from your 401k or income from your whatever pension you have that gets taxed at ordinary income rates. Another benefit in retirement from rental properties, multifamilies, is hedges against inflation. We know, we can feel it now that inflation is going up. It's been going up for the last couple of years, and we see it every day in the prices. But what also goes up is the value of our properties. And, as the government keeps printing more money and inflates the money supply, bailing out banks, bailing out businesses, stimulating the economy, that increases the money supply, and just economics 101, as supply, if you have more of something, the value of it goes down.
Right.
So, and that's one of the reasons why our real estate goes up, because it in terms of our paper dollars that we're printing, it's
Right.
worth more of that, because the value is it holds its
The
value.
relative value
Yeah.
stays the same.
Right.
Yep.
So, instead of saving cash or trying to save in retirement, to accumulate enough of something that's diminishing in value,
Right.
a good strategy is to invest in multifamily properties that can keep up their value over time
Correct.
and provide income. So that's
And
another
obviously,
benefit.
think about rents, right? You buy a property, today. So let's just say 10 years ago, you go to the store, you spend, okay, again, I'm going to show you guys that I'm not the one who shops in our household for food, but let's say 10 years ago, you go to the grocery, you spend $200, right? And you're charging rents of $1,000 per month. Well, you go to the grocery today, you're spending $400 instead of $200, right? So you've doubled what you're spending. But guess what? You've also increased rents from $1,000 to $2,000 a month. So that's how you're able to maintain. And then, right, so that translates to cash flow and how much income you're getting as the landlord of this property, as the owner of the property, getting these benefits. But that's just to illustrate how your investment works over the years to maintain the value, to maintain the value of the money you've invested, as well as how it works to continue to feed you, right? Speaking of retirement, right? If we're going to talk about a retirement. So if you're on a fixed income, right, and you've got your rental property bringing your income, well, guess what? As you're increasing rent, it gives you more cash that you can now use for your own expenses, your own livelihood.
Yeah, that's true. Let's look at another benefit in
Well,
retirement.
before we get to benefits, let's talk about a little bit of, benefits of multifamily itself. I mean, real estate investing, I think everybody can agree that we're big proponents of it. That's why we're here. And the benefits of investing in we talk about investment, benefits of investing in real estate. Now let's talk about the multifamily itself a little. The nitty gritty, right? The benefit of multifamily, and Craig mentioned it, right? For all of you listeners, that when you have a vacancy of in a multifamily, right, the other units are carrying that cost. And essentially, the way I look at it is, if you have multiple apartments, those multiple apartments are carrying that one roof and that one foundation, right? Whatever issues are with the roof, it's multiple apartments taking care of it. Any issues with the foundation, it's multiple apartments taking care of it. So you've got, diversification within a single property, right? That's what multifamily gives you. That if something happens, you have other units to help you along with it, right? Other rents continue to coming in, right? In a 4-unit property, a single apartment that's vacant, there's only 25% vacancy instead of 100% if it was a single family rental. That's the benefit.
Yeah.
On the other hand, we would be remiss if we didn't mention that it comes with its own challenges and unique, issues to deal with. The other tenant is noisy. They're smoking in their apartment. The smoke is drafting into mine. They left the garbage out. I'm not cleaning the hallway. It's their hallway too. They're the ones who left the mess.
Mm-hmm. Their dog is pooping all over the yard, Yeah. We can go on forever and ever, but at the end of the day, I think once you have, we have the rent coming in, you have a property manager in place, you have systems to take care of these items.
Correct.
And the bigger the problem you can solve, generally the more income you'll make. So
Correct.
you can, there are strategies to manage all of this. And that's what we do here at Idani Property Management all day. We help investors help manage their property, maximize their income in retirement, and help them acquire more properties. So
Correct.
There's a solution for every problem.
Right. And that's that those are the pros and the cons, right?
Yeah.
One of the obviously the big benefit of multifamily, you've got multiple incomes, you've got expenses kind of spread out over it. The drawback is that if you ever want to sell it, you're most likely selling it to another investor. You typically don't have somebody buy a 10-unit property and then move into one of the units. That's
Right.
they're
And
not
that's the
buying.
problem. That's the problem because usually investors want the best price. They don't want to pay retail. They want to pay, investor prices. And, typically
Well,
it's not someone moving into a home and they're willing to pay for the
right,
home factor and pay a little premium for that.
correct.
You're dealing with another investor who wants to
Who
get you.
theoretically also knows how to read a spreadsheet.
Right. Yeah. That's true. So, Mark, let's say we have a rental property. How can we optimize it? Say we've had it for a couple years. How do we make sure we're optimizing the rent? We're keeping up the value. We're, you know, making sure that it'll give us income for a long time.
So, Craig, funny enough, between the two of us, I should reverse that and I should ask you that question.
Oh,
I've got, obviously I have my answer, which is I find great property managers to take care of my properties. And just to clarify for everyone, I own properties in Connecticut that Idani takes care of. Okay. At the same time, I own properties in other states where Idani is not available to manage, otherwise they would. And so I had to go out and look for other managers. And before you ask, and to answer the question of Mark, why do you have properties in other states? Because I like diversification. I want to know that if anything happens in Connecticut, my properties in other states can carry it, and vice versa. If anything happens in those other states, my Connecticut properties carry me. Years ago when Craig and I were buying in Bridgeport, we didn't know that there would be talk of a casino. Now, the casino did not materialize, but certainly the talk of it, gave a boost to our values. So it's, again, diversification, right? I have a self-directed IRA that I invest into different things as well. It's not, all my money does not go out into a single deal. So I'm a big fan of diversifying my risk, right? Diversifying my investments so that if something happens in one investment type, other investment types help. If something happens in one city, other cities help. If something happens in one state, other states help. So I'm a big fan of that. And regarding my real estate, what helps me is my property managers. Now, there is kind of a guiding principle for me personally. I don't know if anybody ever saw a movie called The Super with Joe Pesci. And, to me, my biggest fear has always been to ever be called a slumlord. That's my kind of baseline. I must not be a slumlord, right? I have to, my properties have to be, in the end run, my guiding principle is if I had to live in one of them, I would live in, that I could live in one of my properties, right? The units are good enough, right? Families can live in them, kids can play in them. So that's my baseline, which means it needs to have working, appliances. It has to be, clean, neat, right? So when tenants move out, before we rent it out, we turn over, right? If we need to paint, we paint. If we need to fix holes, we fix holes. I mean, everything needs to be in operating condition. But I'm not super involved in this, right? There's market rent that's available, right? That apartments will go for. So I kind of keep an eye on it, and the manager and I discuss what rent I want to charge, right? It becomes a question of do I allow pets? Do I not allow pets? In my personal case, I just have a limit on the size of the dogs, right? For example, with dogs, a limit on the size, kind of a Cocker Spaniel size is the limit where I want to go to. Just because, again, animals will add wear and tear on the property. At the same time, you can charge more rent for it, and you just have to account for it, right? You're allowing animals, fine. The rent has to be higher. Your maintenance and wear and tear and expenses are higher. At the same time, in some markets, without allowing animals, you're just not going to have tenants. That's the simple reality. So you have to be aware of this and account for it. But again, being that my main answer is property manager, I'm going to turn this around and say, Craig, what do you do to increase the value of properties and make sure they're performing the best for owners?
Well, I thought you'd never ask. So, I mean, just a few of the strategies. I mean, we we try to raise rents, every year to keep up with inflation. Things go up, property taxes go up sometimes, insurance goes up sometimes. So we need to make sure that your rent is keeping up, not only with the market but with the expenses of the property. So we're pretty diligent to renew our leases with increases. Sometimes small. We take into account a lot of factors: the paying ability of the resident, um, what size unit they have, what's comparable in the market. And we typically we try to reward good paying tenants with a not so large of an increase. But we definitely want to keep your rents up where the market needs to be, so that you don't have a loss to the market rent. So that's number one. Number two, the tenants are not going to pay that increased rent if the property is in shambles. So we really make sure that everything is working as it should. Make sure they have hot water as always, heat, obviously, um, pest control is in place in the Northeast. Pretty much keep the communication lines open and friendly with the residents, so we can resolve anything quickly that needs to be resolved.
Sorry,
But
speaking of
also on
pest
the other hand,
control,
yeah,
sorry, really quickly, I'll throw this
yeah,
in. Speaking of pest control, that's your that's something you have to consider in a big way with multifamily. Just
yeah,
remember, right? You can't exactly turn around, in a single family house, pests are the responsibility kind of the tenant living there. If they're slobs, then guess what? Cockroaches will be in their apartment, in the house. I mean, it sucks for the landlord, but it's kind of on them if they're, not keeping up with the cleanliness. In a multifamily house, a single tenant can, create a problem for everybody else.
right, right. So that's why we make sure we have our pest control, and before the tenant moves in, we walk them through what's expected of them in terms of cleanliness and taking care of the property, and making sure to report things so that we have additional eyes on the property, and we make them owners. This is their home, this is where they're going to live. So we have that talk to make sure they're taking some level of ownership in this property. um, while we do make sure to maintain the property, there's some maintenance expenses that we can wait on. At the end of the day, we want the cash flow to be there. So if there's a large expense that can wait, or if there's an expense that the resident wants that's not in line with the owner's budget, we work with the owner to make sure that, okay, maybe we do it next year, or maybe we plan it out, or maybe we try to find a vendor that can do it at a budget that suits us.
Hmm.
So expense management is a big part of making sure that the property performs to budget and as expected. So those are the three big things that we try to do to make sure that the property keeps performing at its highest level. Yeah.
Okay. So actually, you said what in terms of actually, I would like to talk about budget management and saving up for expenses and things like that. What do you do in your properties? Like give our viewers kind of your
Yeah. So for
what do you,
me, right, I mean, whatever comes in rent, I try to save 10% of that for maintenance.
okay,
Um,
okay,
that's, I treat that as an expense of the property. I have a special separate account that goes into
okay,
for maintenance, and it's pretty much untouchable for anything other than maintenance. It's
okay,
in a high interest account. It's earning some interest, but it's still
okay.
pretty liquid. And I save in there religiously to save up for those repairs that will come. I mean, a lot of
Yep.
these properties, they're not brand new. They have they're old, so they will need repairs. So that's what we do. Another thing regarding repairs is, and this is kind of like could be a touchy subject for some, but home warranties. I know some people hate them, some people love them, but for us in Connecticut with older properties, I personally love home warranties, especially for the 4 units and under, because I mean a lot of the equipment sometimes is older. With tenants, there's always unexpected issues, and the home warranty just kind of smooths out that maintenance expense. So it's, we don't have, a $12,000 heater repair unexpectedly. It's with the premiums that we pay, it's being saved up for by the insurance company, but it's there.
Right.
And it can be taken. It's just another level of security. And of course, you have to find the right company. Some of them are really shitty. Some of them are pretty good. So you really have to.
You didn't hold back on that one.
Yeah, you have to find the right one that works for you. But that could be, especially with older properties that typically deal with a lot of maintenance, that could be a good strategy to smoothen that out. Because I think the number one thing investors worry about is unexpected capital expenditures. You get a call from your property manager, hey, the sewer line is clogged, then we need to excavate it and put in a new one. It's going to be $12,000, and we've had to make that call. Sometimes, and it's hard, but their insurance policies for your sewer line, their insurance policies for your water line, their insurance policies for your appliances, for your heaters, for your boilers, for your electrical, for your plumbing. So, I mean, I think it's a great idea to look into these things. I think the best investors have insurance. It's just, if it's provided, it's there. It's a good strategy to diversify your risk, among a pool of other investors. And some years you use it, some years you don't use it, but it could be really good for your returns for an older property, I think.
Okay. I second your 10%, by the way. I do the exact same thing. 10% of all of the income coming in gets set aside, and that's my repair fund. Sooner or later, it's going to come. Something will break. I don't know if we've mentioned previously, when I buy a property, I set aside 2 months of everything day one. I set aside 2 months of the mortgage payments. I set aside 2 months of that repair budget. Pretty much day one, 2 months gets set aside. And it's funny, again, the 6-family building, Craig's very familiar with it. And it's pretty funny because when we purchased it, pretty quickly afterwards, 3 hot water heaters died at the same time. And, it was funny because everybody said, oh my God, 3 heaters dying at the same time. How can that be? And to me, my background's engineering. I said, that's pretty good consistency in a product there, because I have to figure when the property was being built, 6 units got put in at the same time. And for 3 of them to go at the same time, that's, manufacturing consistency. But I didn't care. I had the money set aside. I knew it had to happen sooner or later. When we purchased it, we knew that they were, coming towards end of life. Did I want them to last a couple of more years? Sure. But when it happened, we simply replaced them and moved on. And now there's 3 brand new ones, not so brand anymore. I mean, it's a few years old, but there's 3 units that are repaired or replaced now. But we didn't care because we set the money aside. So have that repair budget sitting aside, ready, for when you need it.
All right. Yeah, that's a great tip there. So, Mark, we're coming up on the hour mark here, so let's wrap up. But just some of my thoughts on adding real estate, multifamily property specifically, as a big chunk of your retirement assets. They give you cash flow in retirement. You get some tax benefits in retirement. Yep. Property appreciates, so you also adds to your net worth and your balance sheet as the value of an asset that you can tap into during retirement. And, we want to strongly encourage all investors to add multifamily properties into their strategy for retirement. Pick up a multifamily property once every couple years,
Yep.
as you're getting there, to diversify your retirement income, because it could be very good for you. Any closing thoughts, Mark?
In general, it's buy real estate. They're not making more. They're not making any more of it. So I would just in general say buy rentals, multifamily, single family. We'll be covering single families in a different call and their own benefits and drawbacks. But in general, just get real estate as a investment, as part of your overall investment portfolio, both for right now and for retirement.
All right. Okay, guys. So thanks for joining us in this episode. We'll see you again in another episode. Take care.
Till next time.
Bye.